Welcome to Everything Money. I'll cut right to the chase. No BS. Don't tag anything. As Tom Nash, one of our subscribers says, don't touch anything. Don't touch anything. Don't subscribe. Don't touch any tickle thumbs up. Listen to me carefully. Before I met this gentleman to my left, Paul Gabriel, I was one of you. I invested in all the hype. I did what my friends told me to do. And I had 140 shares of Amazon. A friend many, many years ago told me, buy the companies you love. I loved Amazon. 140 shares. I had 80 shares of Tesla. A lot. I believed in the company. I wanted a dream car. I put my down payment on the car 2 years early for a Model 3, and I had 3 Bitcoin. My neighbors, my friends, got to get in on those Bitcoins. I bought 3 of them, somewhere in the price range of $3,000. Now, Paul will say till his dying day that he never told me to sell, and he didn't, as he doesn't tell you to buy or sell anything on this show. He gives his advice as to how to become someone like himself, what he would and wouldn't do. But what he kept on telling me and just teaching me this process, next thing you know, I started thinking, boy, this is pretty risky. Amazon, Paul, was starting to make up a majority of my portfolio. Tesla was a majority of my portfolio. And God forbid anything happened to any of these companies. I could have been out a lot of money. So I ended up selling. And then the title of this video is, currently right now, with the prices, I calculated Tesla up into their higher point, which a lot of you say they're going to be. It was 1 million, almost $1 million exact, $1 million and $1,060,000. I mean, it was $1 million that I currently don't have in my portfolio right now. And I'll tell you right now, actually, Paul, you know this, and the fans know this. I have about $450,000 saved.
It'd be $1.5 million now.
I'm sorry.
That'd be $1.5 million right now.
Oh, $1 million. It would be $1.5 million. I currently have about 450 saved. I did not get my first job until I was 30, so we're only talking 10 years of savings. So that's my story. And I have to sit in this, Paul, and realize that you didn't tell me to do this, but I need to be happy with this. And the more I learn from you, I really am. So the point of this video is I want you to learn why you can be happy doing this disciplined approach and not following this crazy train of hype into buying these companies that might not be the best purchase. And Paul Gabriel is going to explain why, my dear friend Paul.
So I want to repeat, he would have $1 million more today if he didn't meet me. This very second, he'd have $1 million more.
It's true.
And guess what? I feel zero remorse. And here's why. One, I think Amazon, Bitcoin, and Tesla are going to be a lot lower at some point in the future than they are today. Could I be wrong? Absolutely. I've been wrong so far. And like most people out there, they say, Paul, you've been wrong in the short term. And they, therefore, in their heads, make it seem like I'm going to be wrong in the long term. Fair enough. But then I go to history. Our trusty head of Everything Money, Tim, just said it's like the casino. Guys, I believe I read somewhere once that 85% of people who enter a casino are up at some point. And yet the vast majority leave down over long periods of time. That's exactly the same thing about owning these as your major assets. Because if he kept these, his mentality always be, look how much money I make. He'll chase every other one in the future and he'll lose far more money. The example I always bring up is the dot-com crash of the 2000s. If you bought all those dot-com hype stocks today, you would only have double your money over 20 years. And the vast majority of that, of the doubling of the money, 80% of that gain would have been from Amazon, Apple, and Microsoft. All 3 of those companies would have made up 80%. And that Amazon was going from $6 a share to $3,300 a share where it's at today. The reason we teach disciplined approach is that over long periods of time, you will avoid all of these. You will not get the ones that go up 500 times. But what you will get is good, solid companies that are going to be around for a long period of time and give you the cash flow and the returns that you want and that you need as a disciplined investor. I always tell Seth, I say, Seth, if you don't sell now, when are you ever going to sell? That's the point about him never selling these. If he never sold these, he's assuming he would have sold today. Well, what if it doubles again? What would you say? The thing is, when everybody's winning, they think they can never lose. That's the whole point about the casino that Tim brought up. That's what I'm trying to get across, everybody. We're trying to teach a disciplined approach of saying you're going to miss out on big gains on stocks that don't make sense and investments that don't make sense, like real estate. I still hear people in real estate talking about, oh, look, it worked for me. Yeah, it worked for you because interest rates plummeted. It didn't work for you because the deal was good. Isn't it weird that all of a sudden bank financing tightened up in 07 and the crash happened? All of a sudden, the good deals don't become good anymore if people aren't allowing you to actually fund these deals. The same thing here. When companies are losing money, remember, Amazon just recently started making money. Amazon just recently started making money. But if you don't have if you don't have this cash flow and these fundamentals, eventually something bad will happen. And if your mentality is always going big or go home, you will eventually be caught. At some point, as Warren Buffett says, we never know who's naked until the tide recedes. The tide has not receded in the last 10 years. In the last 12 years, that's a problem. It lets a lot of people think they're geniuses. Just remember, investing is simple, but it's not easy. Is it possible for everybody in the world to be right on Bitcoin? No, it's not. You cannot have so many good investors. It's just, if I asked you to name the top 10 investors, you probably have a hard time even naming 10 good investors in history.
Mm-hmm.
But yet we're sitting here, and I'm glad Seth says that, and I don't believe for a second that Seth is really okay with it. Maybe he is. I'm sure he's more okay with it than he would have been years ago, because I'm sure all his friends who kept Bitcoin and kept all these Tesla are like, man, I'm loaded. But at some point, they're going to end up selling, and it'll probably be at the wrong time. And that's just it. Like, we're trying to teach fundamentals here, and I love the comments. Paul, you don't get it. I know I don't get it. That's the point. I don't understand it, and that's why I avoid it. That discipline has worked for so many great investors over long periods of time. In the short run, do we look stupid? Absolutely. Am I okay with that? Absolutely. That's just it. I'm trying to teach the long-term disciplined approach.
So I struggle with this. I'll be driving around, Paul, and think about, sometimes this will cross my mind about how much money I would have had not knowing you.
If I could go back in time and go 5 years back, do you know how much more money I would have? If you would have had $1 million more, do you know how much more money I would have had?
How you mean?
It's obscene. If I bought all these companies 5 years ago.
I see, of course.
Right?
Yes,
so I look and guess how much FOMO I have. Zilch. And the reason being is they didn't fit with my process.
So I think tell the viewer the whole point of, I sometimes break down the whole point of the show in that even if you as a viewer are against these ideas of maybe a more disciplined approach, and you're right many, many times with the Bitcoins and the Ethereums and the Dogecoins and the whatever thousands of coins people are interested in, value investing is still better, right, Paul?
Over long periods of time, value investing is better. However, if you don't get it, if it doesn't click with you, I don't recommend you doing it.
Mm-hmm.
I recommend you do. The problem is all the ones who talk about Bitcoin and Ethereum, they don't know. They just sit there and say it's the technology. Guys, there are 4,000 plus cryptos. They all have that technology. So which one's the right one? Which one's the right one? How many currencies do we have in the world? 200? I don't know how many currencies we have. Which one's the right one? Well, then you're going to go, what countries are they in? What's the inflation like? What's the stability of the country? There's fundamentals that drive it. If the whole point of crypto is just based on the same technology they all share, which one's the right one? I can go start a cryptocurrency tomorrow. Heck, our Dynasty Owner game basically has its own digital currency, right? We have Dynasty dollars. It's not the same exact thing, but the whole point is if we wanted to create our own crypto, we could. So what makes ours worse or better than anything else? It's just people's perception of it. And you're going to be out there saying, well, what's the difference between that and a stock? Well, at least with a stock that's generating cash flow and a piece of real estate that's generating stable cash flow, I have that cash flow. Look at our houses in Mexico. We have 2 houses in Mexico.
Yeah, Mo's a part owner in these.
Mo's part owner. We have 2 investments. And this is what I always bring up. This is a great example. One was $900,000 and one was $1.3 million. So we have a total of $2.2 million invested in these 2 houses. What are they worth today? I bought this one in 2013. I bought this one in 2017, finished it in 2018. What are they worth today?
You tell me.
What do you think they're worth today?
Mosif?
I don't know. Don't know.
Doesn't
Don't
matter.
care either.
Don't. What are you writing?
Don't care.
Don't care.
Why don't I care?
Because they're paying you on a monthly basis.
Because every single, a bad year for us will be a 12% cash return with these things paid off in cash. I have no debt on these, and I'm going to make 12% return, upwards of 20% per year. All I care about is, can I still get this cash return? Now, over long periods of time, as I get these cash returns, will this value go up? Absolutely. Heck, I can justify selling these for probably double based on this return. This is a 12 to 20% cap rate. Right now, people are buying assets at 5% cap rates. Mm-hmm. This is over double that.
And they're happy with it.
I don't care what the return is. I don't care what the value is. Same with a company that's a stock. If they build their balance sheet and buy back shares and pay down debt, you'll get the value there.
You don't care about the stock price. It just
I
hit
don't.
me.
It just
hit me.
I don't care about the stock
Because
price.
you don't buy and sell on the stock price going up and down.
I correct. What I'm buying is good, stable companies that are getting better balance sheets, getting good cash flow and higher returns on its capital. That's what I care about. The rest will take care of itself.
Mo, you're a young kid. How did you get on this train of believing all this stuff? It is a belief, Paul, really.
Of course it's a belief. And if it doesn't speak to you, it doesn't speak to you.
Well, it spoke to me early. I didn't dive into it as much until I met Paul. Well, I started spending more time with Paul and going into it. But I always had this more conservative belief, and I wasn't really. I'm not a person that's going to go and chase things. I'm not trying to get rich quick. I've never wanted to get rich quick. It's all about enjoying the process of getting it. I played baseball for a number of years. It was the same thing. Start here and just keep working your way up. It's no different than that.
Well, you bring up baseball, Mo, and Paul, one of our favorite movies that we love is
Moneyball,
which I watched again this past weekend.
I watched it this weekend.
Yeah.
Okay, but here's the problem, Paul. And this is where I hate to be one of the haters, but we do get a lot of hate. Moneyball worked.
Sort of.
Sort of.
I mean,
by the way, it worked in what sense? How did it work? He didn't win a championship.
No,
you're right.
I mean,
But how did it work, though?
To be at the major league level and to be competing with teams like the New York Yankees and Boston Red Sox and LA Dodgers and go in there with that market, what do you call it?
But Paul, that's such a rare occurrence. This
Well, it's a
doesn't
rare
play into-
occurrence. By the way, that's exactly it.
This doesn't play into your favor of playing the Moneyball game because it's only happened one time in the last.
No, exactly the opposite.
Go on, tell me.
The discipline, now baseball's changed because of Moneyball.
Yeah.
So
I
now
see.
the people who are getting paid $140 million are the ones that have the attributes that were being paid $39 million before. And that's why it's harder for the Oakland A's to win a championship now. The great news is, with stocks and in real estate, there are tens of millions of investors out there. They're all going to chase hype. Baseball's got 32 teams, whatever the number is, right? So there's very few owners. So it's harder for it to be different because there's only 32 teams. But that's the thing I love about Moneyball. It's about looking at sports a lot different.
And you know, Seth, if you look at it, it kind of is the same thing as if you're chasing after, I'm going back in time, the A-Rods and these high-priced players, you're going after the hype instead of looking for the value, and you're doing the exact same thing. So the A-Rods of the world back in 2003, whatever, when he was with Texas and New York, that's the Bitcoin maybe. That's the Tesla of today. And what the A's were doing was totally different.
I gave a speech a few years ago about investing, and I said about Moneyball. In Moneyball, Jonah Hill's in the parking garage, and he says, baseball teams look at things wrong. They look at buying players. They shouldn't look at buying players. They should look at buying wins.
Yeah.
And how do you buy wins? You buy runs. How do you buy runs? He didn't say this part, but how do you buy runs? You get on base. Same thing with investing. You guys all look at, I'm buying ticker symbols.
Yep, ticker symbols and where it
I'm
can
buying
go.
I'm buying location. No, buy cash flow. Cash flow buys you. The cheaper you can pay for cash flow, the better you're going to be. Now, obviously, cash flow involves the future, and there's more growth potential. You should be willing to pay more. But the problem is, what happens is we see something skyrocket, and we just think, oh, the potential's huge, as opposed to, oh, wait a second. How am I going to? If I were to buy this company or buy this real estate outright in cash, what would my returns be? That's where people stop. You have to look and invest. You have to look at buying returns. How do you buy returns? You buy cash flow. How do you buy cash flow? You buy revenue at cheap. All these things work together. It's no different.
When I was reading, I had my call with Gary last week about the Philip Fisher book, Common Stocks, Uncommon Profits. And it was interesting looking through the 4 parameters that he goes through. And the very last thing that he looks at is stock price. He looks at all this other stuff. He looks at the balance sheets. He looks at the personnel. He looks at the shareholders. He looks at everything. And then he looks at stock price. That's the very last thing he looks at.
But don't worry, guys. Everybody out there who says we're wrong, you and the other 300 million people, it's been proven over time that when the masses believe something, it ends up being good. Guys, in investing, there is one truism.
Go on.
Where everyone else goes, that's what you should avoid. Go look at every single historical hype, everything. You will never, ever find one that has the masses believing in it that end up being good.
If you're sick and tired of chasing these coins, chasing these fluctuating prices on these high-end companies, you can come join our team. And I'll tell you what, I have convinced my 10-year-old that this is the process that he's going to be investing in for his entire life. And so he'll hop off the bus and talk about companies you've never heard of and their balance sheet and their free cash flow. Because, you know, Paul, he's on that Everything Money website looking at those pillars. And I'm finding it more fun to find these diamonds in a rough, Paul, than keeping up with the Joneses And in the end, I have tons of friends who they bought into this stuff, and none of them have any more money. I mean, they bought the Bitcoin high, they sold low. It's just,
But then by the way, here's what they do.
Go ahead.
Here's exactly what happens with hype. Goes up, everyone buys up here, comes down, everybody sells right here, starts to go back up. Everybody then buys over here, and then here's where we are, in my opinion. I don't know we're going to turn over, but at some point, it'll crash again and people will sell. This is why people don't beat the market. This is why people don't even match the market. Because every emotion is about, like, oh, this could be a fad. Oh my God, it's a fad. Look at the money I've made. Look at the money I've made. Okay, it'll come back. And by the way, this is what usually happens. It usually goes like this. Oh my God, we were wrong. Oh, look, we were right. Oh, we were wrong. That's what happens usually. Okay, it's just, this is being played out. Guys, humans haven't changed much in the last few hundred years, realistically. We still have the same emotions. We still have the same responses, the fight or flight kind of thing. It's not even if you're just sick of not understanding. That's what I want everybody to do. Like,
Yes.
We believe in momentum and charts and fundamentals. We believe in all these things. If you're just sick of not having a process that you can believe in, that's what you need to do. Because at the end of the day, investing is only about a process. And those who deviate from the process do worse. I sometimes wonder if my value investing, I'm too thorough about it. Like Gary is insanely thorough.
Yeah.
Mo and I talk about pulling the reins back a little bit and being a little less thorough and just following a certain process and sacrifice maybe 2 or 3% a year, but make up for it on the options part. We've talked about this many times because I don't want to sit there and go interview customers and ex-employees. I don't want to do that. I want to sit there and find good companies at great prices or great companies at good prices, as Warren Buffett says. I don't believe that what I'm going to tell you is necessarily going to resonate with you, but something will from this channel. And if you like a process, if you like understanding, come learn. It's very simple.
In the end, I'm perfectly fine, Paul. I am perfectly fine not having that $1 million in my account because I know literally for the rest of my life and my children's life, because of what you and Mo have taught me, we're going to have a very disciplined way of looking at our investments.
You will do far better.
Yeah, and you've taught me. I mean, we're now talking, Mike, we're now talking if I don't even do that much better, I'll be at $10 million when I retire. And if I can get to 12% returns, I can get to $27 million. It's absurd. And so, yep, I'm fine with that. I lost $1 million and I'm okay with it. Thankfully, I met Paul that one fateful Cavs game, re-met Paul, and everything money spawned out of the
And a rare event for me was going up and saying hi to somebody.
I would have avoided you too, for sure.
I was
don't
just
want to
like,
talk that guy.
The only reason I said hi to him, because I saw him at a previous Cavs game one section over, and the only reason I said hi to him was he happened to sit next to another friend of mine, and they were on the Cavs Instagram account. I texted her and said, "You're sitting next to a kid I went to high school with." She's like, "I know, you came up in conversation." I was like, "What the heck?" So when I saw him like a month later, I said, "Seth." He was like, "Paul." And then Beth was like, "Paul, nice to meet you." I was like, who is this woman?
For the record, I'd avoid both of you.
That's our show. See the Patreon below if you want to get in on this. Paul, the Patreon's incredible, and we do live streams just for you. And so we found maybe around 2,200 people all over the world who have gotten into our community, very like-minded, and boy, do they support us to the end. Also, join the Patreon. It goes up every single week. The price increases. Get in now. That's our show. Love you guys. See you.